Joe Cusick. He is a senior market analyst at OptionsXpress. Still on set with us is Nadal. Joe, ahead of the speech, we also have JP Morgan reporting if they do well, which Diamond has forecasted throughout the quarter, will that float financials and then float the market back after losing 118 yesterday?
Well, I mean, watching the markets overnight, I've talked to a lot of, believe it or not, even in this early in the morning, I've talked to a lot of OptionsXpress customers about the activity that's been going on in Japan specifically. We're opening up with strength. JPM has always done an outstanding job so far in the last year or so with their earnings, and that expectation is built in right now. Financials have been lagging currently, so this news would be a solid boost. Also going into banks' earnings this week, we need these large cap financials, these banks, to start getting moving, to really start getting this market moving. But with the action overnight in Japan and seeing the most activity and the largest boost we've seen since this crisis has begun is really encouraging going into the markets today.
Joe, I have a question for you. People are expecting sort of $96 to $99 of earnings on the S&P. S&P's around $1,300. So you're talking about 13 times earnings or thereabouts. The market, by any historic standard, is very inexpensive. Why is it that the market doesn't have a clear direction and we're essentially flat for the year?
You know what, I think that's an excellent point, and I think one of the reasons why is, first of all, we have great earnings and we have inflation, and people are trying to figure out how they want to trade this market, and also the headline risk is unprecedented at this stage. You would think that the S&Ps would be at 1450, 1450 or higher at this stage, just with the earnings power, but again, headline risk, and the fact that we really don't know. I think you're getting some debate and some uncertainty about the impact on the economy coming in June 1st, QE2. QE2 has been a great policy, and I'm going to say that out loud, a great policy for what it was intended for. Now, whether or not they continue that policy is up for debate, and that's what the market is keeping its eye on. We'll watch earnings over the next month, but going into June, excuse me, that's what I think right now investors, that's why especially large institutional investors that are in this market aren't piling in anymore. Excuse me.
Joe, I have a question. I'm bullish on QE2 as well. I think it did a ton for confidence of investors. I'm not sure how much it actually affected GDP growth, but it did a ton for confidence. Do you see the elimination or its termination changing investor confidence, or do you think it's already factored into the market at this point in time?
I think at this point in time, it's factored into the market. I think that further quantitative easing is going to be a threat with the inflation that we see on the forefront. We see Europe has already stepped up and started ratcheting up rates. We see that China has also been ratcheting up rates. And as a matter of fact, one of the government economists came out overnight and said they won't dispel the fact that they are probably going to raise rates 2 more times before year end or even the next quarter. Excuse me. So I think right now the confidence of the investor is still very much so tied in the earnings power right now that we have domestically. But the long and short of it is that people are concerned if in fact we still see $5 gas and the consumer does start to pull back, which they haven't, but if they do, then GDP is going to start to get impacted.
And you're right, and it's such a precarious situation. I don't remember quarter where so much was riding on these corporate profits and this earnings season. Joe, we appreciate your time this morning. Miles, always a pleasure. Thanks for being on as our guest host.